I hope you're following Robert Kiyosaki's advice and paying yourself first. However, if you're paying yourself first, do you have any other options as opposed to a traditional savings account? In today's example with Denise, she's going to talk about a fantastic alternative for wealth building and offering a bunch of other benefits. Take it away, Denise.
Thanks for the introduction, Steve. Hello, everyone. This is Denise Boisvert, Insurance and Estates guide / coach. Excited to talk to you about a topic today that a lot of people are doing, but I want to show you a better way to do it. I'm going to compare traditional bank account savings versus high cash value whole life policy. Now, who should own a high cash value life policy? Before I answer that question, let's first ask, do you pay yourself first? Meaning, do you make sure a percentage of income goes to you before paying bills or meeting monthly obligations? If your answer is no, it should be yes. And if your answer is yes, where are you putting those funds? If you are putting your savings into a traditional bank account, I would like you to consider a better alternative, which is a high cash value whole life policy. Let's just do some quick comparison between a traditional bank savings account and a high cash value whole life insurance. First, let's look at the earning rate. Now, the earning rate, according to bankrate.com, for an average bank savings account is 4.8%. If you are in even just say a 12% tax bracket, then your net interest is 4.2. If you're in a higher tax bracket, then obviously it's going to be a lot less, because we all know that at the end of every year you receive a 1099 for interest earned on your bank account. If we compare it to a high cash value life policy, most companies offer a guaranteed 3%, and then you have dividends on top of that. And those dividends are usually anywhere between 2 and 4%. So you're looking at a net earnings of 5.7%, which is tax-free. You do not get a 1099 for gains in a life insurance policy. Let's look at withdrawals and earnings. When you withdraw from a traditional bank account, basically what happens is your balance gets lower. You're still earning 4.2%, but you're only earning it on what is left in your account. As opposed to a high cash value life policy, your withdrawals are taken from your cash value, and your full cash value is still earning that 5 to 7% tax-free. Basically, when you take a loan from your cash value account, it doesn't come out of your account. The insurance company is basically giving you that money as a loan. It is deducted immediately from your death benefit. So your death benefit reduces, but your cash value does not. So the compounding interest and dividend growth is not impacted by you taking money out of your contract. Let's talk about loans. When we take a loan, we don't have the option of taking a loan from our traditional bank savings account. We would need to apply and get approved for a loan, which would be a separate account with the bank. However, with a high cash value life policy, loans are available from our cash value, and no approval is needed. It is our money. The amount borrowed, like I said before, still earns interest and dividend. So it keeps that compounding going. Let's look at loan repayments. When you get a loan from the bank determines what your schedule of payments is, how many years you have to pay it back, how much you have to pay back each month. If you're late, you may get a late fee. If you miss a month, it may impact your credit score. Unlike a whole life cash value, we have no required payments. You are in totally control of how you want to repay your loan. You are in control of when you want to repay it, how much you want to repay it, or if you want to repay it at all. If you don't repay it, it's just going to stay off your death benefit. Let's look at added benefits upon death. Well, the only thing we can really do with a traditional savings account is put what we call a POD, which is a paid on death option, meaning when you pass away, your account will go directly to whoever you list as your beneficiary. With a high cash value policy, we have a death benefit, which is considerably higher than what we actually put into our account, right? Because life insurance is buying dollars with pennies. Your death benefit is always a multiple more than what you put in. And that amount is going to go tax-free to your beneficiaries. Living benefits. There really are no living benefits in a traditional bank savings account. However, there are in a high cash value. Most of the benefits I'm going to mention now come free of charge with your policy. Most companies do not charge for them. We have a chronic illness rider, which basically, if you ever need long-term care, what they will do is they will advance you part of your death benefit to help you with that care. You have to qualify for it, but it will be available. Accelerated death benefit rider. That is, if you ever were diagnosed with a terminal illness, you can also tap into your death benefit and you can use that money for whatever you need at that time of your life. And then third, you are protected from third-party creditors in most states. So your cash value is not subject to, if you get sued, they can't tap into your cash value, whereas a traditional bank account, that would be at their disposal. Look at the costs. Basically, the only cost for a traditional bank savings account is the fact that you're not earning more money in your whole life policy. The cost for the high cash value, there is a cost. There is a premium for that death benefit. However, that death benefit is a benefit. The premiums paid are to your advantage and they maximize your legacy. So I want to show you a simple illustration so you can just see the impact of choosing a whole life policy to build your cash accounts. And I'm going to use one of my clients, Craig. He is age 27 and he was looking for a place to start saving for some personal goals. He wanted consistent and protected growth as well as liquidity. He was already paying himself first each payday. He had an automatic deposit going into his bank savings account of $200 a month, which was earning less than 2%, and he was being taxed on his gains. He chose to redirect his life policy, his bank account, to a life policy. And when he did that, he kept the same amount, the $200, so he's putting in $2,400 a year. The policy actually allows him a range, a premium range. He can either, the minimum he would have to pay for this policy is $46.16, and the maximum is $316. So he has flexibility in his premiums, and that's what's nice about these policies is he may commit to $200 today, but maybe life will happen and he can't afford it, and he can only put $50 in. Well, that's okay. He can do that. Or maybe things get better and he wants to put more. He can put up to $316. And once he hits that $316 consistently, he can always open up another policy to add more if he wants. You can have as many of these policies as you want. I always advise my clients, do not open a second policy unless you are maximizing your first. So let's just take a look at his cash values. So in year one, he puts $2,400. He has $1,595 in cash value. By year 5, he has $10,000 in cash value. Let's say he wants to take a loan in year 5. Now, you don't have to wait 5 years for a loan, but he decided he wanted to because this was really a savings he was trying to build up. Let's say he takes an $8,000 loan. When he takes out that loan, his $10,537 will still earn interest and dividends. The $8,000 will come off his death benefit until he pays that back. And like I said, he's in control of how long he wants to pay, when he wants to pay that back, how much he wants to pay it back, if he wants to pay it back. He also is in control of how long he wants to pay this policy. He could stop paying in year 10 if he wanted. He could stop paying in year 7 if he wanted. But probably because he's so young, he will continue to contribute to this policy because as the years go by, this momentum just picks up and you can see it in the cash value. And you can also see it as the cash value grows, the death benefit also grows. So there's a lot more features in these types of policies, but today I just wanted to focus on the difference between putting money in a traditional bank account and actually, I want to say, investing it into a whole life policy. So I am going to turn you back to Steve, and he is going to wrap this up and give you some action steps to take. Thank you so much for joining me today, and I hope you have a great day.
Okay, thanks Denise. What a fantastic example, an exciting example for somebody that's already paying yourself first. That's key. And you can see how her 27-year-old client was able to get all kinds of money momentum, putting his 10% savings into a high cash value life account, properly designed. He's able to do that. He's able to get an accruing death benefit, money momentum for his whole life, as well as living benefits, guaranteed growth, tax advantages. So great option for you guys if you're already paying yourself first. Thanks, Denise. If you guys are interested in this, looking at it, there's going to be a calendar link wherever you're watching. You can schedule on Denise's calendar. Also, leave questions, comments. We do respond to comments as long as you keep it classy. I'll see you in the next one.